The following production is presented by League Info Site and the Credit Union Broadcast Experience, QTV.
Hello, I'm Shawn Wolbert. Thank you for joining me at the CU Compliance Connection, brought to you by InfoSite. On October 24, 2013, the National Credit Union Administration issued final rules for credit union liquidity and contingency funding plans. The goal of the rule is to strengthen the federally insured credit union liquidity risk management, which the NCUA states is crucial to ensuring the credit union system's resiliency during periods of financial market stress. The requirements for contingent liquidity funding were controversial when proposed, but the NCUA has stated that the events that followed the mortgage crisis and the rapid reversal in market conditions and availability of liquidity during the crisis illustrated how quickly liquidity can evaporate. The NCUA believes that many of the liquidity-related difficulties experienced by financial institutions were due to lapses in basic principles of liquidity risk management. The liquidity and contingency funding requirements differ based on the asset size of credit union. All federally insured credit unions must have a written contingency funding plan that is appropriate to its complexity, risk profile, and scope of operations, that sets out strategies for addressing liquidity shortfalls in emergency situations. Credit unions with assets less than $50 million must maintain a basic written policy that provides a credit union with a board-approved framework for managing liquidity and a list of contingent liquidity sources that can be employed under adverse circumstances. Federally insured credit unions with more than $50 million in assets must have a written contingency funding plan that addresses, at a minimum, the sufficiency of the credit union's liquidity sources to meet normal operating requirements, as well as contingent events. The identification of contingent liquidity sources, policies to manage a wide range of stress environments, identification of some possible stress events, and identification of likely liquidity response to those events. Lines of responsibility within the credit union to respond to liquidity events. Management of processes that include clear implementation and escalation procedures for liquidity events. And finally, the frequency that the institution will test and update their plan. Credit unions with assets greater than $250 million must also establish and document access to at least one contingent federal liquidity source for use in times of financial emergency and distressed economic circumstances. These credit unions must conduct advanced planning and periodic testing to assure that contingent funding sources are readily available when needed. The NCUA allowable contingent federal liquidity sources are regular membership in the Central Liquidity Facility or membership in the CLF through an agent, or by establishing a borrowing access at the Federal Reserve discount window by filing the necessary lending agreements and corporate resolutions to obtain credit from a Federal Reserve bank. The CLF and the Fed discount window exist to provide backup liquidity to credit unions and other financial institutions in circumstances where on-balance sheet liquidity and market sources are inadequate. Both have similarities and are collateral-based lending facilities. During the recent mortgage crisis, both the CLF and Fed discount window met emergency liquidity needs for individual institutions and for entire systems. When making a decision about a liquidity funding source, it's important to note the differences between the two. The discount window can advance same-day funds to qualifying credit unions, and their loans may be renewable, but rollovers are expected to be brief in duration. CLF funding can take up to 10 days in loan durations up to 90 days. In certain circumstances, these loans may be renewed for an additional term. The new requirement does provide guidance for growing credit unions that assets reach a higher level of compliance requirements. When a credit union's call report shows the higher asset level for 2 consecutive reports, the federally insured credit union then has 120 days from the effective date of the second report to meet the greater requirements for liquidity. All credit unions will be affected by the new NCUA requirements and should review the rule as it affects them to determine if they are in compliance. The Liquidity and Contingency Funding Plans rule is effective on March 31st of 2014. Thank you for joining me at the CU Compliance Connection by InfoSight, only on Cube TV.
Thanks for watching the #1 compliance program for the credit union community. Stay tuned.